Hiring your kids could save you thousands this year in taxes. At some point, almost every business owner I talk to has heard some version of this. Just put your kids on payroll. It sounds like a shady tax trick, and it's not. It's a real strategy written into the tax code, and when you do it right, it's one of the cleanest tax moves available to business owners with kids. I'm Daniel. I help business owners stop overpaying the IRS every single year, keep more of their profits, and start building real wealth. In this video, I'll show you exactly what makes this strategy legal, what crosses the line, how much you can realistically save in taxes, depending on how your business is set up, and why the smartest use of this money isn't just the tax deductions, it's what you do with it after. Most business owners who hear hire your kids picture something pretty informal. Maybe they've got a teenager who comes into the office a couple times a week. They hand them some cash for helping out, maybe track it loosely in a spreadsheet somewhere, and figure that's close enough to call it wages. The business owners who do it the right way think about it completely different. They don't think of it as just paying their kids. They think of it the same way they think about bringing on another worker. There's a job, there's a rate, there's a paycheck, there's a paper trail. The only thing that's different is the person doing the job happens to share their same last name. And when you set it up that way, like a real employment arrangement, the tax code rewards you for it in a way that's hard to match with almost any other strategy. So let's talk about what this actually looks like. What makes this legal? There's a three-part test. The IRS has a straightforward standard for whether wages paid to your child are deductible. Three things have to be true. The wages have to be reasonable for the work has to actually happen, and the money has to actually have been paid. That's it. It seems pretty simple, and that's the whole test. And the reality it is, but people make it too complicated. And when you read it this way, it doesn't sound that complicated. It's the same standard that applies to any employee you hire. The IRS isn't inventing a special hurdle for family members just to make it difficult. They're just making sure you're running a real employment arrangement, not a paper one or something made up for a child. So, what does this look like in practice? First, the pay rate has to make sense for the job. If your 15-year-old is doing data entry or some other basic task at $75 an hour, that's going to raise a red flag. The benchmark is simple. What would you pay someone off the street to do the same or similar work? That's your starting number for salary. Second, the work has to be real and documented. Keeping timesheets, dates, hours, tasks, things like that. Don't just throw a rough estimate at the end of the year and hand it to your CPA, because that's actually not a real record. That's you just making it up. Third, the money has to actually move. A check or direct deposit into an account your child actually controls. Not cash in hand, not a running tab you settle at Christmas, not a mom and dad's bank account type stuff, but real money transferring into their account. And one more thing that trips people up, you need to issue a W-2, not a 1099. This matters. A 1099 treats your child as a self-employed contractor, which means they'd owe self-employment tax on every dollar. A W-2 is the right form for an employee, which is what your child is in this arrangement. Now, what kind of work actually qualifies? The IRS has accepted things like office filing and scanning, answering phones, cleaning business premises, data entry, social media management, and appearing in company ads or marketing material. If your business has a legitimate need for it and your child can generally do it, it likely qualifies. What doesn't qualify is household chores rebranded as business tasks. The work has to serve the business, not the family. Here's the thing. Most business owners I talk to aren't doing any of this. They either don't know it's an option or they've heard about it but never set it up properly. They've got kids who are old enough to do real work, a business that could generally use the help, and they're paying taxes on income that could have been shifted out of their tax bracket entirely, but they don't. If that sounds familiar, that's worth paying attention to, because the math we're about to get into is going to make this feel a lot more real. Let's put some numbers to this. In 2026, the standard deduction is $16,100. Because wages are earned, income a child's earning up to that amount and its legitimate wages pay zero federal income tax. Not a reduced rate, but zero. So between $0 of income up to the standard deduction, they're not paying any income tax. You, on the other hand, are paying taxes on every dollar of that income at your rate. If this money right here were going to you, what is your tax rate? It's probably a lot higher than zero, potentially 35 to 37% bracket. Now that's 37 cents of every dollar going to the IRS before it gets to your family. So here's what the strategy does. You pay your child, let's say, $15,000. That $15,000 comes off your business income and off of your bracket, your tax bracket. And if, let's say, it's 37%, that's roughly $5,500 of taxes that's not paid to the IRS. Your child deposits that money, file a return, and they owe nothing. The same dollars, two completely different tax outcomes, depending on whose return they show up on. Now, if you're a sole proprietor or a single member LLC, there's an additional layer. Children under 18 working for a parent's sole prop are exempt from FICA. That's Social Security and Medicare, which combined run a 15.3%. So again, if we're looking at the numbers here, on $15,000 of wages, that exemption alone saves you another almost $2,300 on top of the income tax savings. If you're running an S-Corp, the FICA exemption goes away. Your child is treated like any other employee for payroll tax purposes. But here's what matters. The income shift still works. Again, let's say at that 37% bracket, the owner's savings of $5,500 in income tax still comes out well ahead. Even after accounting for payroll tax costs, the math is different, but it still works in your favor. One more thing worth clearing up, because this objection comes up every time. Some business owners have heard that the kiddie tax kills the strategy. It doesn't. The kiddie tax only applies to unearned income. Think of things like dividends, interest, capital gains. This is earned wages, not unearned income. If you've been told otherwise, whoever told you that was confusing two completely different situations. So the income tax savings, they're real. The FICA savings are real for the right structure, and the kiddie tax concern is a non-issue. The math holds up. But here's what a lot of business owners stumble, and it's not the math, it's the execution. Because doing this wrong doesn't just mean losing the strategy, it can mean losing the deduction entirely. Here's the pattern I see most often. Business owners hear about the strategy, start paying their kids here and there, figure they'll sort out the paperwork later. End of the year rolls around, they write one big check, call it wages, and move on. That's not a strategy, that's bonehead tax management. That's a deduction waiting to be denied. Think about it this way. If you hired a stranger off the street for the same job, you would have a rate, a schedule, a timesheet, and a W-2 in their hands by January. Why wouldn't you do the same thing for your child? The IRS expects the exact same thing here. And the only reason people get tripped up is they let the family relationship make them casual about something that requires them to be deliberate. It's not that hard, but you have to be real. You have to treat it like real employment, real records, real deduction. Shortcuts on this are one of those things that make it all fall apart. So practically that means keeping timesheets as you go, not reconstructing them at tax time, a pay schedule that matches hours worked, a rate benchmarks against what you'd pay someone outside the family for the same job. And the money has to actually move into the account your child controls. Not cash, not a family account, but their account that they own. Do that, and this deduction is airtight. Skip it, and you've got a problem. Here's something that goes beyond just paying your kids and getting the deduction. This is where planning and strategy comes in and starts to benefit not just them now, but also in the future. Because your child now has earned income, what that means is they're eligible to contribute to a Roth IRA. So you could help them set up a Roth IRA and make a contribution. And in 2026, the contribution limit is $7,500. And as a parent, you can help with that contribution on their behalf. All the children needs is to have earned at least that amount in legitimate wages. Now, keep in mind, if your kid during the year only earns $4,000, that is your limit. They have to earn at least as much as their contribution. Now, if they earn $10,000, your limit is still this $7,500 right there. So keep that in mind as you pay your kids, as you set this structure up, what you want as far as a contribution to a Roth account if you want to help set them up. So think about this. You now have the ability to contribute to a Roth IRA for your child. Let's say they're 15 years old and your child earns about $15,000 a year. You deduct it from your business income. They owed nothing in taxes. And now you put in $7,500 of that into a Roth IRA where it will grow completely tax-free for the next 50 plus years. Let that sink in for a second. A single $7,500 Roth contribution made when your child is, let's say, 15 at long-term market returns could grow to roughly $880,000 by the time they're 65. Now, remember, this is all tax-free. That's just 1 year of contribution. Imagine if there was additional money contributed and you started your child off with a retirement balance in their teen years. When I walk a business owner through this for the first time, the reaction is almost always the same. They can't believe they've been sitting on this and didn't know about it. Because what you're really doing here isn't just saving on this year's tax bill, you're moving dollars out of your highest tax bracket and into your child's zero bracket, taking a full business deduction and with those same dollars, starting a compounding engine that could run for half a century. No product, no complex structure, no exotic arrangement, just the tax code working exactly the way it was designed to for the business owner who knows how to use it. There's almost nothing else in the tax code that stacks this many benefits into a single move. Now, if you're sitting here thinking about how much tax you've been paying right now and wondering what else you might be missing, that's exactly the right question, and it's worth getting the actual answer. I work with business owners on a proactive tax reduction planning year-round, not just at tax time. If you want to find out where your biggest opportunities are, I'd invite you to schedule an intro call. Look at how your business is set up, where the tax exposure is, and what moves make sense for your specific situation. The link to get that on the calendar is in the description below. And if you want to take the money that you just saved and put to work in the most tax-efficient retirement account available to a business owner, that's exactly what the next video covers. The self-employed 401k lets you save for retirement and cut your tax bill at the same time. Click right here to watch that next.